Hi, everyone. Good morning. Thank you for joining us today for the third session of our webinar series, Financial Services, COVID-19 and VAT. Just to share a little bit of background of our webinar tag series, we have covered issues on VAT return preparation, as well as the latest MVR VAT updates in the first two webinars. We have had a healthy level of participants and really appreciate your support. If you're not able to join any of the previous webinars, fret not. We have both webinars recorded and shall be posted on our website. So you can go to Keypoint website and look for the links to the webinar with videos. So today, the webinar will be a little specific. Our target audience for today's webinar will be those from the banking sectors and other financial services. On to the next slide. My name is Omar Hisham, a senior manager with the Keypoint Tax team, and I have my colleague here with me, Zainab Miraj, who will also cover some of the topics to be discussed today. We also have Mubin Khadir, our head of tax, and Dauhan, one of the managers of the tax team, who will be joining us as fellow panelists. The webinar will run for about an hour, including a Q&A session. Should you have any queries during the session, please feel free to use the Q&A function to pose your queries. We'll try our best to address them as and when time permits. All right, next on to our agenda for today. So the agenda will include the following: measures taken by the Central Bank of Bahrain, VAT implications arising from CBB measures, other considerations, measures adopted by tax authorities and businesses. So we will start off with Zainab. Zainab will go through some of the measures as communicated by the CBB through the issuance of their circulars and guidelines. To you, Zainab.
So to start the measures taken by CBB, I'll go briefly through the circulars that have been issued. So we've seen a range of circulars starting from the 5th of March until the 30th of March. The circulars, some of the circulars had general guidelines relating to operations, while some of the circulars had issues that may or may not have VAT implications. So to start off with the circulars, the first circular was issued on the 5th of March. This was addressed to financing and microfinancing licensees. It had mostly to do with the CBB ensuring that, telling the licensees that they need to ensure that they're ready and that they have their business continuity and disaster recovery plans ready. Another thing that the CBB has addressed through that circular was that the financing and microfinancing licensees should look into ways to mitigate any impact on the borrowers as well as customers and consider introducing concessions. The CBB has also requested that for any such concessions that are given to customers, forms need to be filled and reported to the CBB. The next circular that we've seen was on the 8th of March. That was more to protect the public. This was issued to providers of merchant services. So regular sanitizations of the screens and keypads that you see at the shops, and avoiding to handle customer cards, always asking the customer to insert the card from the POS machine. This was followed by another circular on the 11th of March, which is also operational because it relates to the disinfectation instructions. So a list of instructions were published by the Ministry of Health, and these were included within the circular. This included how disinfection happens in workplaces, how it happens at home, as well as home quarantine disinfection. The CBB has also addressed licensees and told them that they need to start engaging with the public by showing the measures that they have followed to protect both their staff and customers, whether in the press or social media. Next, the next circular issued was on the 12th of March. So again, the CBB has urged businesses to ensure that their business continuity and disaster recovery plans are ready. Funding transfer systems, you need to ensure that they are operating effectively and normally. Regular and adequate refilling of ATM machines with cash, so people wouldn't people would still have cash in ATMs when they want to withdraw. And the CBB also mentioned in the circular that they're ready to provide the cash for such measures. The next one was no changes on the agreed terms and conditions relating to the trade finance transactions. And the last one was to ensure that customers have access to banking services through designated branches as well as electronic channels. We've seen that with a couple of banks where they've closed certain branches, they've reduced the number of branches that are operational, and they have started introducing more services that are available through online banking. So the next circular, which was the one that had most of the measures that need to be taken from an operational perspective, especially for a bank. So for the circular issued on the 17th March addressed to all licensees, these measures take immediate effect for 6 months from the date of the circular. So we've seen that there was deferral of installments at no fees, no interest, or no interest on interest or profit on profit for Islamic banks, and no increase in the rates for 6 months unless the borrower agrees for a shorter period. So by default, there's a deferral for 6 months unless the borrower requests the banks for a shorter period. Days of stage 1 ECLs has been increased to 74 days. And cooling off period for reclassifying restructured credit facilities has been changed. Would have an impact on the bad debt relief. Liquidity ratio limits were reduced for locally incorporated banks. Capital adequacy risk weightages have been reduced for Bahrain SMEs to help them cope with the current conditions. Loan to value ratios on new mortgages has been reduced for Bahrainis. NFC limits for contactless cards, contactless transactions without PIN has been raised to 50 BD. This would help, this would reduce the number of people touching the keypads and entering their PIN. We also have seen that there was capping of merchant fees distribution. The VAT implications would be covered in the next few slides by Omar. We have also seen that the CBB has mentioned that there would be concessionary repo arrangements. This is specifically for retail banks and it will be at 0%, but this will be analyzed on a case-by-case basis. So it's not given, it's more of something that would happen in case it was needed. The last measure discussed by the circular was that the cash reserve ratio for retail banks would be reduced from 5% to 3%. So with this circular, there are quite a bit of implications that we will discuss today, but we'll move on to the next few circulars before addressing that. So we have also seen in the other circulars that a circular on 19th March was issued to all licensees and listed companies. This was again in line with the MOH or Ministry of Health measures limiting public gatherings. So as public gatherings were limited to 20 people, the CBB has instructed licensees and listed companies to conduct general meetings through electronic or teleconferencing means if possible, or otherwise they can reschedule to a date that's no later than 30th of April. Any board elections can be postponed until a subsequent general meeting, but requests for extension of appointments will need to be submitted to the CBB in case of financial service providers or to the Ministry of Industry, Commerce and Tourism for listed companies. In addition, the CBB has also mentioned that any CBB representatives that are required to attend general meetings would be attending through teleconferencing. The CBB later then issued 2 circulars on the 23rd of March and the 24th of March, and these included implementation guidelines for the 6 months deferral discussed in the circular on the 17th of March. So the CBB has mentioned on the circular on the 23rd that licensees may accrue interest or profit on the principal for 6 months. This was followed on by guidelines on the 24th of March that specifically mentioned that the 6-month deferral means March to August 2020. We've seen that a lot of banks have actually deducted installments for March before these circulars. So such installments were later on returned to the customer accounts, and then because of the circular, because it was effective March 2020. So basically what happens is that the original repayment schedule is pushed by 6 months. So instead of paying in March, you will now pay it in September. The CBB has also mentioned that there are no additional charges to customers. The last two circulars issued in March were both on the 30th. The first circular was regarding the implementation of regulatory measures. So all the recent regulatory measures taken by CBB have been deferred, excluding the eKYC rules, which are in the financial crime module. The last circular issued was to all listed companies and locally incorporated banks. There was an exemption from preparing and publishing the Q1 financial results. So what will happen is that the first financial statement to be prepared in 2020 would be in June, and it will cover 2 quarters, so it's going to be a 6-month period. So moving on from the circulars to the implications arising from these, I will pass this to Omar, so he would be discussing the VAT implications arising from the CBB measures.
All right, thank you, Zainab. So now let's move on to the next item on the agenda on VAT implications arising from CBB measures. For the following slides, we will cover a few issues from a VAT perspective on the measures introduced by the CBB. So we have a few points here. So we'll start off with the first point, being the deferral of installments. Right? So as the CBB has mandated banks to defer payment of installments by their borrowers, following this measure, banks will need to consider the potential VAT implications from such deferment. This falls back on the way bank recognizes the time of supply for VAT purposes on its margin profile. Now, especially on the way interest is accounted on loan, time of supply on interest has become an issue in the industry ever since VAT was introduced, with some banks recognizing the interest based on accrued basis, or some would based on actual cash receipt basis. Generally, for supply of continuous services where interest typically falls under, and for VAT purposes, bank would recognize interest based on cash receipt basis, despite the fact that from an accounting standpoint, interest is usually recognized based on accruals. Now, given the current CBB mandate, with interest income will be deferred for up to 6 months, the banks will potentially have lesser exempt supplies or zero-rated supplies if this interest qualify as exported services to be accounted for in the next coming back periods. This may create a gap between what is being recorded in your accounting books and what needs to be reported in the VAT returns. So in this scenario, you cannot expect to see figures reported in the accounting books to match that reported in your VAT returns. This will implicate your PA ratio for the next few tax periods. You may have a higher VAT recoverability rate than usual, and you may expect this to be queried by the MDR, who usually assess your business performance based on trend. You will also need to consider that when you have decided to delay the recovery of your input tax credit, you will still need to apply the PE ratio of the tax period to which the input tax was incurred. Having said this, this should be temporary, as this will eventually be averaged out by the annual wash-up calculations. So even if you have decided to manipulate the recovery of your input tax credit to the tax period when you're making a higher recovery rate, the annual PE ratio will average out the year's composition of taxable and exempt supplies. On the other hand, for some banks who would recognize interest based on accruals basis, provided it meets the time of supply rule, then the measure announced by the CBB may have little to nil impact on your VAT position. However, the gap will be visible when comparing against your cash flow. And also, when using accrual basis, the PE ratio will not be really affected by this measure. The objective here is not really to show one method, i.e. the cash receipt method is better than the other, or vice versa, but rather as a way to show you how the current measure will implicate you given the time of supply that's being adopted. Now, moving on to the next slide, the CBB also mentioned that given the deferment of the installments, there will be no fees or increase in rates for these transactions. We'll refer to the circular that's issued on the 17th of March. Now, we understand in the market currently, some banks are treating the late payment fees as standard rated supplies. And from the core banking system aspect, banks might have even set the system up to automatically populate the late payment fees or penalties in the event of late payment. Given the mandated waiver on late payments from the CBB, question arises as to whether this should be accounted by way of a deemed supply, and VAT still needs to be accounted for and paid to the NBR. For those who are not familiar with this terminology, deemed supply is a VAT concept where supplies have been made, but for no consideration in return. So essentially, in this context, it means you're getting a free supply, you're providing a free supply. Despite not getting any consideration or money in return for the provision of the supply, when it falls under a deemed supply, the supplier must still account for output VAT and pay to the tax authority. VAT in this case usually becomes a cost to the supplier of the service because they are not able to charge the VAT amount onwards to the customers. Coming back to this issue, it is unclear as to whether the mandated fee waiver can be carved out from being considered as a form of deemed supply, given the regulatory mandate. It is also unclear as to whether banks will need to calculate for the total fees waived under this moratorium and get the reimbursement back from the government, or whether this still needs to be accounted as deemed supplied and banks will have to bear their VAT costs and pay to the NBR. A recommended approach, though, would be to obtain clarity from the CBB and, where possible, the NBR on whether the waiver can be carved out from being taken into account as a deemed supply, given the current crisis. This also seems to make a little more sense.
I have a question regarding this. So we've spoken about where banks are treating it as a standard rated supply. So in the case that banks would treat it as an out-of-scope supply, would the same apply?
So if bank treats late payment penalties as out-of-scope, that's, according to Zainab, that's a question, then there is no deemed supply. So technically, penalties is not subject to VAT. It is carved out from the VAT. If you're not charging that penalty, then there is no VAT. Same applies with exempt supply as well. So if, say, for example, interest that you're supposed to charge on the loan, and you're not, you're still providing the loan, but for no interest, then there's no deemed exempt supply for that interest. Okay, so deemed supply only applies on standard rated supply, not on exempt supply or out of scope supply, such as penalties, late payment penalties. That's going on the basis if you treat late payment as penalties. But in the industry, some banks are already treating late payment penalties as late payment fees, a standard rated supply, not really a penalty. All right, moving on to the next slide. So this is in relation to capping of the merchant fees. So CBB also announced on the cap of the merchant fees applicable to the respective stakeholders, right? As you can see, 0.35% cap to the acquirer, 0.25% cap to the issuer, 0.2% cap to the benefit company. Now, given the cap, what if a particular bank recognizes the fee amount above and beyond the cap? So what if you're charging more than the cap? So a few scenarios actually come into my mind here. What if the actual value of the supply is higher than the capped amount? What about VAT? Should you include VAT when calculating the cap, or should VAT be excluding from calculating the cap? So as you may already know, VAT is applicable on the actual value of the supply that you have provided. So if the actual value of the supply is higher than the capped amount, it appears that banks will somehow need to be able to absorb this as cost, and subsequently, when VAT is charged based on the actual value, banks may need to absorb the VAT spillover as their cost, since this cannot be charged to the receiving party. Now, similar to the previous issue, you may wish to verify with the CBB or even with the NBR as to whether the cap includes VAT element and whether VAT should be accounted based on the capped amount or your bank standard charge out amount. Separately, just to draw your attention on the VAT spillover, given that you may account for this and pay to the NBR, but not be able to recover this from the recipient of the services, you may need to assess as to whether this cost can eventually be recovered as bad debt relief if the conditions can be met. Right. Moving on to the next slide. On repo arrangements, we understand that there is a 0% repo arrangement given by the CBP to the banks on a case-by-case basis. This one was mentioned by Zainab according to the circular on the 17th of March issued by the CBP. Now, there isn't really much to talk about on this, as this is fairly straightforward for the bank, but it is worth highlighting that as there is no payment to be made to CBP in this regard, there is no requirement for you to declare this in the VAT return at all, even if it's under field 12. No need to report this payment because there is no payment to be made. All right, so on to the next slide. This is a bit interesting. It's something that probably some of us can really relate. Given the operational measures CBP has requested banks to comply with, such as sanitization and disinfection costs, activation of business continuity and disaster recovery plans, IT development costs, it appears that these costs may have become a novelty during this current crisis. Since these costs are overheads, then as we know it, for banks, these costs will usually be subject to the partial exemption ratio apportionment. However, from another perspective, these novel costs are also mandated by the CBP and may only be for a one-off event. Perhaps, given the current condition, seeking for a special concession from the NBR to allow for a full recovery of this cost may not seem too far-fetched after all. So this is something that banks may want to consider. In other words, one-off novel costs being claimable in full instead of being subject to partial exemption apportionment. It may be viewed as some sort of a VAT relief to cushion the impact of this crisis. But again, this is something that probably a bank will want to go as an industry and approach the NBR and discuss with CBP whether this can be taken as a one-off full recovery VAT input tax credit. Now, so apart from the specific issues highlighted following the issuance of CBP circulars and guidelines, there are also other issues that banks may want to look into during this time of trial. So we've come up with a few issues that we can talk about that most likely will impact banks. Now, on the first issue, that would be bad debt relief. I've touched on bad debt relief previously when going through the merchant fee cap. Apart from that, we are looking at potential default by some of our customers in the near future, given the current economic reality. So maybe it is time to really put process in place to identify potential bad debts and set the procedure straight so that you will be able to recover any VAT that you will not be able to collect. So also on bad debt relief, it only applies on VAT that you have charged and paid to the NBR, but where you have not been able to recover from your customers. So again, on any VAT exempt supplies that you might have made, there is no bad debt relief provision that you can really apply simply because there is no VAT that you had to charge on such a supply. However, on the fees charged, where they are usually by default standard rated, then it may be worthwhile to look into the bad debt relief, especially if the value is material. Now, I think just drawing from the question that Zainab asked earlier, so bad debt relief applied on standard rated supplies because you've already charged and accounted VAT and paid to the tax authority. It shouldn't apply on VAT exempt supply because there is no VAT that you're charging. And what if it's out of scope supply? Again, there is no VAT that you charge and collected and paid to the NBR. So there is no bad debt relief that you can apply for out of scope supply. So it only applies on VAT standard rated supply where you have charged VAT, accounted for and paid to the tax authority, but you have not been able to collect the VAT money from your customer. Now, moving on to the next point, losses made on sale of financial instruments. This will generally impact banks, of course, and also some other financial institutions. Given the current market condition, we may expect that some financial instruments such as bonds, shares, futures, other form of derivatives and securities, etc., may be sold at a lower price than its purchase value or face value. Now, in this case, the MBR has clarified previously on this type of financial instruments. When you're selling them at a loss, you should drop the negative sign, the difference. You should drop the negative sign and report them based on the absolute value. Okay? Drop the negative sign and report them based on the absolute value. And you will also need to factor this into the calculation of your PE ratio. So you drop the negative sign, take the absolute value, report it in your VAT return, and also use this number to calculate your PE ratio. Okay? Right, now, on to the next point. This negative interest, all right? So this seems to be a financial concept adopted by some jurisdictions to stimulate their economies, all right? I'm not too sure whether we'll come across this in Bahrain, but probably some banks who have overseas dealings, you might come across this issue. Okay, so again, from a VAT perspective, what do we need to do? How are we supposed to account for a negative interest rate on loans, right? So negative interest rate on loans works in such a way that the bank, the lender, will provide you with loan and he will pay you interest, right? However, if you place your deposit with the bank, right, another bank, then you will have to pay them interest. Instead of them giving you interest on deposit, you have to pay them. So it works both ways, right? This is a technique or method to stimulate one's economy. Again, from a VAT's perspective, we have to go back to basics and ascertain whether there is a supply being made, okay? A provision of loan is a supply of financial services. Therefore, it is arguable that negative interest will still need to be accounted as a form of consideration for the exempt supply. Okay, so to report this, we may follow the treatment mentioned above, the one on losses made on financial instruments, where we drop the negative sign and take the absolute value. All right, so on to the next point, the last point of this slide. Some banks also hold properties and rent these properties out to external tenants. And given the current scenarios, they waive the leasing fees, right? So banks, being the landlords, deciding to waive their rental income, what's the VAT treatment? Is there any VAT treatment to begin with? All right, so now, if the leasing fees are waived, then there should not be any VAT implications, as exempt supplies are specifically carved out from the deemed supply provision in Bahrain. Right? So I already mentioned about deemed supply just now. Deemed supply only apply on something that should be charged at standard rate VAT, where you have not charged it, you're providing it for free, the supply, you're providing it for free and you're not charging anything to them. So there will be deemed supply. A naturally standard rated supply, right? When you're giving it for free, deemed supply applies. However, for a VAT exempt supply that you provide for free, then there is no deemed supply. Now, so there's something that you must take into account though. If the rentals are merely being deferred for a period and will need to be paid later still, then the VAT implication will still need to be into account based on the applicable time of supply rules. Okay, so for you to waive completely, then there is no deemed supply because it's VAT exempt. However, if you're just deferring the payment, you're telling your lessee, you don't have to pay me now, you can pay me later, then you need to apply the usual time of supply rules, okay?
Omar, just to add on that, because I've had that question from one of my clients this week.
Yeah.
So when it comes to properties, sometimes clients would be charging service charges, of course.
Yeah.
So where the service charge portion is a taxable supply subject to standard rate because the place of supply is in Bahrain.
Yeah.
Just to confirm, for clients' sake, that it does not follow the same treatment as rent because rent is exempt.
Yeah.
So you would still need to look at the deemed supply rules for service charge that you charge on these.
That's true, correct. Yeah. So again, deemed supply applies on standard rated supply. So if there are any incidental expenses that you're charging onward to your tenant, and these are, listed outside of the rental income. So you have rent of maybe 500 BD, and separately you also charge surveillance fees, 50 BD. That's your usual invoice per se. But because of this crisis, you've decided to waive all of this, and that 50 BD, that there is still a supply, there's still maintenance services being performed by you, but you decided not to charge to your customer. You have to be careful because deemed supply may apply here in this scenario. Okay. All right. So moving on, right? So this is something most banks would already see, ever since the implementation of VAT. Also, fluctuations on MTM or mark-to-market valuation. Mark-to-market is an accounting valuation method for reporting purposes. Given the current market condition, it may seem like there are more fluctuations in relation to the investments held by the banks. However, since mark-to-market or MTM is only used for accounting purposes and not in relation to actual supply made, therefore, there are no VAT implications that will arise due to this. I know that most of the banks will already know this and understand this. It's just, I think it's worth highlighting because you might see this a little bit more in this period or in this year. Now, sales of non-performing assets or loans. Banks may also face situations where there are unpaid loans being transferred to NPL books or non-performing loans book. And subsequently, NPL will be sold at a discount to another party. When this happens, the sale of NPL is a VAT exempt supply. Okay. However, the NBR has clarified that this should not be taken into account when calculating the PE ratio. On a separate note, it is probably worth highlighting that given the potential deferment of interest income receivable, but banks are already accruing this in their books, there could potentially be a requirement for a system change or reconfiguration in terms of the period before a loan is being transferred to the NPL book. So this is something that you may want to consider looking into, especially given that certain fees are automatically calculated once repayment has been defaulted after going past a certain period. So I think the thing that I really want to mention here is, look, you need to know the treatment of when you're selling loans under your NPL books, and also you should really take into account your current system or core banking system that you already have in place, given the circular issued by the CBB as well, because you may have set a certain period for loan to be called a defaulted loan or non-performing. However, given the current NBB requirement requesting banks to defer the payment for up to 6 months, probably you want to extend this, you want to change the period before a loan can be considered as non-performing. So it requires you to do some sort of internal system changes as well, and probably procedures and process. Now, working from home, this is something that I really can relate to, working from home. With most businesses now being forced to have a work from home arrangements, there could potentially be some additional costs that you will need to invest in, such as Zoom, Skype, etc. Now, if these costs are being borne by the employer, since most of these vendors are located overseas, then you need to consider a charge mechanism, right? So banks, pay for software license, paid to Zoom, for example, or Skype for corporate use. Then the expenses or the cost that you have to pay, you need to make sure that you're accounting for VAT on it based on the reverse charge mechanism. On the other hand, if the employees are being requested to purchase some of these software or applications out of their own pockets under their own name and subsequently to be reimbursed by the employer may not be required to account for this under the reverse charge mechanism. However, where these software vendors are charging local VAT to these employees, of which they ought to do so, then the VAT amount will not be recoverable by the employer. So it will essentially be a cost. So if me as an individual buying applications from Apple, for example, from iTunes, for example, Apple or iTunes will need to charge me with VAT, local VAT, Bahrain VAT. And if I were to get this reimbursement, I want to get this reimbursed by the company. Given that the invoice is under my name, it is, the company will not be able to claim that VAT as input tax credit. So arranging for this work from home thing, you need to look at the infrastructure that you already have and infrastructure that you will need, and see how are you going to manage the VAT implication on the cost of acquiring this infrastructure. Now, on to the next one. Government grants to pay Bahraini employees' salaries, right? So we know that this has been announced. We also see this on the news. As these grants are given to the companies with no supply of goods or services that is required to be provided in return by the companies to the government. In other words, these grants are not a type of consideration in return for a supply. Therefore, they are out of scope for VAT. So there is no really a condition of me being required to provide a certain service or certain goods to the government in order to get the grant from the government. So because of that, there is no supply to begin with. And this is a general government grant. So because of that, then it is treated as out of scope of that. Okay, so I think we've covered pretty much the issues that were covered in the circulars released by the CBB over a course of month. I think there will be more circulars or guidelines to be issued by the CBB still, giving further guidance in terms of how we should maneuver this around. We really hope that we'll be seeing some things from the MBR as well. We know that MBR has been sending some information requests or survey requests to some of our businesses. So I think we can expect that there should be some updates from the government side in relation to this, in particular with regards to the banking industry and also VAT. Right now, I will pass the next topic to Zainab, where she will walk you through on some of the measures that are recommended by the OECD to tax authorities and some measures that businesses or banks in this case can consider to improve their tax, especially on their tax position during this crisis. All right, after you, Zainab.
So we'll go through the measures adopted by both tax authorities and businesses. So we'll address what the tax authorities have been doing and what OECD has been recommending first, and then we'll move on to the businesses. So what can tax authorities do during this time? We've seen so far in Saudi as well as UAE and Oman, measures have been taken to ease the current conditions on the taxpayers. So from an OECD perspective, a list of measures or responses in tax policy, from a tax policy perspective, have been communicated so that tax authorities can consider them. So we can see that the first one is extending deadlines. We've seen that happen in Saudi for all taxes, whether it's VAT, withholding tax, zakat, excise tax. Deadlines have been extended by 6 months. Deferral of payments, any payments due within this period can be deferred to a later period. Remitting of penalties and interest.
Sorry to disturb you. I think I just want to also highlight that as of yesterday, quite recent, the UAE has also extended the deadline for the March excise tax. This is in relation to excise tax though. So they've extended the deadline for excise tax submission and payment. Right, so by right for March tax period or for excise, you need to submit it by the 15th of April. So they have moved this to until 17th of May. So it's just 1 month period.
Okay, we've seen that, just like Omar mentioned, we've seen that in KSA, UAE. although there are no announcements by the NBR yet, which is something that I get questions about every other day from clients. The next, the other steps that have been mentioned by the OECD is to alter debt payment plans. So any payments that are due to the tax authority, where payment plans are set, these can be altered to make sure that the burden is eased on businesses. Suspension of that's collected from the tax authority from businesses would be suspended for a certain period of time. Tax authorities can also look into providing quicker refunds to ease the cash flow on businesses. Providing tax certainty, this comes when there are gray areas and the tax authority needs to provide more information within about a certain issue. Altering audit policies, so maybe suspending any audits that are currently going on, except for cases where, of course, you're auditing any fraud that has happened. Enhancement of services, so tax authorities can also consider adjustment of services that are available for taxpayers. This would include use of digital channels, dedicated hotlines, and longer opening hours of maybe telephone centers. And the last point, of course, is communication. So tax authorities have been encouraged to make sure that they have clear communication strategies. This would include having a dedicated web page, having media communications, whether it's through social media or other means, and also consideration of how to identify and reach vulnerable taxpayers who would be having some issues due to the current economic circumstances. So moving on from what a tax authority can do to what a business can do. And this is not specific to banking, it's general to all businesses. So from a VAT perspective, what can we do? We can shift tax due dates on supplies to delay output VAT payments. So where applicable, maybe not raise an invoice if you have not provided the service or good yet, because that would make sure that you don't have any output VAT due to the tax authority. You can consider where periodic invoicing might reduce output VAT payable. So that's another option from an invoicing perspective. The third option would be ensuring your accounts payable team are processing valid tax invoices so that you recover your input VAT as soon as possible. You can also make sure that you claim your input VAT before you pay your invoices. So where you have received valid compliant tax invoices from your suppliers, but you have not made a payment to the supplier yet, you can still claim the input VAT even before the payment. So that's another option that you can consider. For bad debt relief, maybe possible for certain debts that have not collected previously. Just to expand on bad debt relief, this you will need to make sure that 12 months has passed and the debt has been written off, except of course except of course where the customer is has been solvent. So the next one is assess whether you're eligible for quarterly returns. There's a VAT return modification guide where you want to modify your return period. So you can move from monthly to quarterly, provided that you meet certain criteria. You would need to apply to the NBR and you would receive a notification of approval or rejection. And the last point that we're discussing is you may want to assess any previous positions taken. So for example, the absolute value for banking, maybe you're still reporting it because this has been clarified through a circular, maybe you're still reporting it the old method that you have been. So maybe you can consider looking at those updates that the tax authority has recently announced, and maybe see if certain assessments are required, which would ease the VAT burden on you.
So I just want to add on one point, this is just going back on the bad debt relief, if possible. So now we know that the circular is saying that, look, banks will need to give a deferment on the installment payment. So now it's a 6 months deferment, right? So you have 12 months being one of the conditions for bad debt relief, right? So you need to make sure that the debt has not been paid for 12 months. Now, the issue here is on how you're going to calculate the 12 months. Should you include the 6 months, or should you not include that 6 months as well? So the way I look at it, because the 6 months is mandatorily required by the CBB, and CBB still requires you to actually accrue this interest. So you are still not able to calculate your bad debts from the first day of the default payment. You shouldn't include the 6 months into the 12 months. But what you should do is, after that 6 months has passed, probably that will be your first day of calculating for that 12-month period. So essentially, it will take you 18 months, given the current crisis. It will take you after that, from the start of the deferment or non-payment until the 18-month before you can actually declare it as bad debt relief. And again, maybe it will not apply to a lot of the charges. Maybe you can't apply bad debt relief on interest, but probably it will apply on certain things like late payments, some fees or charges, commissions, and stuff like that. Again, you may want to consider whether you also are allowed to write it off regulatorily or legally. You're allowed to write off all these debts as bad debt, and whether you can probably take some legal action as well for non-payment. So these are a few factors when you need what you need to consider before you can apply the bad debt relief provision. Okay.
So this sums up our webinar for today. So just to mention that we have an economic substance requirement on Thursday, which is relevant for Bahrain-based multinational group entities, as well as regulated sectors like the banks and the financing companies or insurance. We'll just move to the questions right now.
Yeah.
Hi guys, so there's been a lot of good questions that have come through. We've tried to answer as many as we can, but there's still some that we can go through now, maybe have a bit of a discussion.
Okay,
so first one.
We have a couple of questions. The first one is, what happens to the 12-month rule for continuous supply? Is it deferred for 6 months as well?
So this is something that to be honest, I'm not too sure on how NBR would view this, because the deferment actually came from the CBB. So the way I look at it, just like how I look at the bad debt relief earlier, so probably given the current scenario, the deferment or the 12 months of continuous supply also when it elapsed, I think you should. It's something that you may want to look into and seek for clarification from the NBR. But again, a VAT rule is a VAT rule, right? So it talks about 12-month rule. So if the moment the 12-month rule has lapsed and you need to account for VAT already, you should technically account for VAT already. It's just that you may not be able to get the payment, and you may need to pay it upfront to the tax authority first, right? And see whether you can later on recover that as part of your bad debt relief.
Okay, the next question is, can we treat negative interest as a purchase and not a supply?
All right, so again, when we are referring to this negative interest, we first look at whether there is a supply being made. Okay, so if I look at my own sale, right, I'm providing a supply. I need to provide a supply first before I can consider anything that I receive in return as consideration. So so under a normal interest scenario where I provide a loan, the provision of that loan is a supply to me. So then I should be getting an interest in return for the provision of loan. So that margin will be considered as my consideration. Now, on the other hand, if you're looking at if negative interest, you still need to go back to the fundamental or back to basics. Who's actually providing the supply, right? If I'm purchasing something from Zainab, for example, Zainab is providing the supply, right? It doesn't make sense for the other person when it comes to a negative interest scenario. When I'm placing my deposit, I need to pay interest, or when I go and get loan and I get money for getting that loan, is it the action of me going to the bank and getting a loan? Is that a supply? I don't really think so. So in that sense, the way I look at it, you go back to the fundamental, look at whether there is a supply being made, regardless whether it's a negative interest or positive interest, it's still considered as a consideration. However, the best position right now is if we can really get MBR to put it up in writing to clear the doubt or to clear the air for everyone. Okay, thank you.
Moving on to the next question. The question says, I don't have to apply reverse charge mechanism for services imported by my employees and reimbursed. So to answer that, if, as Omar has mentioned, so if your employees are buying softwares in their own name and then they get a reimbursement, reverse charge would not apply. But if they're buying it on your behalf and it's merely them paying on your behalf and then you're reimbursing them, then this would constitute a supply that's subject to reverse charge mechanism. The next question is, if I have applied the reverse charge mechanism to overseas interest expenses, should I amend any previously submitted VAT returns? So going back to the basics, reverse charge applies when you buy services from overseas that would have been taxable if they have bought locally. As you've mentioned in the question, you're referring to interest expenses. So as interest is expense, the reverse charge is not applicable to interest. So what happens is that such interest expenses that are incurred from abroad would need to be reported under Field 12, which is purchases from registered zero rated or exempt purchases. If you've done that in your previous return, you would need to perform a self-amendment on the VAT return and ensure that it's reported correctly. The next question is regarding annual apportionment. I did not take into account supplies made at a loss. What should I do now? So I'm assuming this refers to the absolute value again. So you would need to go back and look at the circular. If you've done that before the circular or before the NBR has clarified on how to calculate it, then we think that should be fine. But if it's after the circular, maybe you can look into your VAT returns and check whether there's any VAT difference. If these have been more than more than one tax period prior to the current tax period, then you would not be able to report them in the current tax period. So maybe you can look into self-amendment. Anything you want to add on that one?
No.
Okay. So the next one is that the NBR is currently reviewing my records and they have found that I have made some mistakes as I have reported the principal amounts in relation to securities too. What is the best way to deal with this? So what I understand is that instead of reporting the realized loss or gain, you reported the total sales value of the sale of the securities. So the best way to deal with this is to amend your returns. Yeah. Most probably these are prior returns that are previous than more than the prior tax period. So probably you would need to look into amending your VAT return.
Yeah. And I think another thing is because most of these securities that you reported would generally be either exempt or zero rate. So you kind of need to go back to the previous returns and actually amend that returns.
Okay, the next question is handwritten tax invoice with all required VAT requirements for tax invoice can be considered VAT compliant? So a handwritten, there's nothing in the legislation that says that you cannot do handwritten tax invoices. But the issue with handwritten tax invoices is that these can be easily manipulated. So if you have a control process for these, then it's fine. Otherwise, you might have issues if there are numbers rewritten on certain numbers. The next question is, I forgot the annual apportionment calculations. Shall I report in my next return, or do I have to make a disclosure? So we assume that your first tax year was 2019. So if you have been registered effective 1 January 2019, then you would be expected to make your annual adjustment calculations either in your last tax period or your first tax period of the next year. So if you're on monthly basis, this would be December 2019 tax period or Jan 2020 tax period. If you have not done that, then you would need to amend your previous tax return.
Right.
Although if you're on quarterly basis, you still have time to report it in your first tax period of 2020.
Yeah.
Do you have anything to add on the self-amendments?
Yeah.
Okay, we have a few more questions left. So we issue bank statements for a certain period, for example, 1 Jan to 31 Jan, but our bank statements don't have an issue date because of system issue. Can the end date of the statement be treated as the statement issue date?
No, you kind of need to indicate what's the actual issue date.
The next question we have is why overseas interest should be reported in box 12 of VAT return if the RCM is not applicable. So box 12 would include any purchases from non-registered vendors, zero-rated purchases and exempt purchases. Where you have zero-rated or exempt purchases that are from overseas vendor, by default, these are not subject to reverse charge, so you would report them under box 12.
Yeah. Waiver of fees due to COVID-19 will be treated as deemed supply? Potentially, yes. Potentially, because deemed supply doesn't really matter whether it's COVID-19 or not, right? So if you've provided a service or provided a supply of goods or services, right, and you've decided not to charge it to the customer, but you still perform the service, essentially a service that you're providing it for free, then you still need to account for deemed supply. Of course, we're hoping that the MBR will give us some clear guidance in terms of whether there will be some concession in this regard as well. But from a VAT perspective, if you're providing a service for free and you decided not to charge your customer, or you're told not to charge your customer, then you still need to account for deemed supply. Okay, this only applies on standard rated supplies. Now, there is another question on bonds, but this one, I think we'll address this in writing, and we'll give this back to you. All right, I guess that's about it. Yeah, so we'll post this. We'll post our video on the website, and probably we'll post the Q&A as well on the website. So for those who are interested, you want to check back this video, please. We are happy for you to go to our website and just click on the link to the video. Also, just to another shout out to the panelists, thank you guys, and also to the team. There's also another seminar, a webinar, ESR webinar on Thursday, in relation, which is relevant to the Bahrain-based multinational groups, entities, and regulated sectors, banks, financing companies, and insurance. Okay, so you tune in. That will be the 4th session of our webinar tax series. Right. So thank you everyone for attending today's session. Stay safe,